Welcome to today's tutorial. Today we are going to talk about the double entry system, which is also known as the golden rule. Now, every business transaction has two parties involved, and each party, this double entry system has a double effect on each of the parties involved. Now, what this double entry system simply talks about is, for example, if I have this marker and I sell this marker by cash, meaning there are two accounts involved. There is the marker account and also the cash account, because I'm selling it by cash. So I always use the T format, but if you have another format apart from this one, you can use it. Every format speaks the same language in accounting. So if I sell this marker by cash, meaning there's an account, there are two accounts, the marker account and the cash account. So the account that has received the value of this item, the account that has received this item should be debited, and the account that has given this item should be credited. So we'll talk about that in details. So now, under this double entry system, there's a statement which says to every debit entry there is a corresponding credit entry. To every debit entry there is a corresponding credit entry, or to every credit entry there is a corresponding debit entry. Now, if we debit this account, the cash account, by 50 kwacha. So if there are two accounts involved, the marker account and the cash account in this case, if we debit this account by 50 kwacha, definitely we are going to credit this other account by 50 kwacha. So this is what it means. This is what this statement means. Every debit entry has a corresponding credit entry, and this makes it easy for you to understand the account, because once you understand the account that is receiving the value of that item, or the account that is receiving the item, when you understand where that thing should be placed, that thing should be placed. If it has to be placed on the debit side of that account, just know that you should do the opposite to that other account. So that is what this statement means. Now, we've been talking about accounts. An account, the account that is receiving and the account that is giving. And someone might ask, what is an account? So an account is a detailed record of financial transaction related to specific item. So this is just a record of a transaction, and it is recorded in the ledger. So an account is just it's just something that keeps a record of a transaction in a ledger. That is just a simple definition of an account. Now, under this very thin account, this very thin account is classified into different classes of accounts. So let's talk about the classes of accounts to see how this very account has been classified. So let's talk about the classes of accounts. The classes of accounts. talk about the classes of accounts. So we have the personal account and the impersonal account. So now, what is a personal account? A personal account is an account that keeps a record of, let's say, people and names of an organization. Keeps a record of names of people's, the names of people's accounts as well as the names of the organization account. So it's an account for persons. That's just a simple definition. And other than that, we can even talk about the organization because it deals with the names of people and the names of an organization and companies. They all fall under what is known as the personal account. We have impersonal accounts. Under impersonal account is what we call the real accounts, as well as the nominal account. So now, what is a real account? A real account, this is an account that keeps the record of the real things which the company owns. Real accounts, this is an account that keeps a record of the real things which the company owns, things that are tangible in nature. So a real account is tangible, deals with tangible stuff. It's tangible in nature. So things that we're able to see and touch. A very good example is a motor vehicle. The assets, in short, a motor vehicle is something that we're able to see and touch. Buildings, land, these are things that we're able to see and touch. So these accounts falls under the real accounts. The motor vehicle account, the land, machinery, land, buildings accounts, they fall under what is known as the real accounts because these are tangible stuff. You are able to see and touch them. And then we have nominal accounts. So now, these nominal accounts, the nominal account is intangible in nature. Intangible. Meaning it deals with accounts of stuff that you are unable to see and touch. An example is a salary. Salary is account. Nobody has ever seen a salary. It's impossible. You can't see a salary. So let's say you receive maybe a salary by cash. Salary by cash. So that thing you see, that's cash. So if you receive a salary by cash, meaning there are two accounts involved. There's a salary account. There's also a cash account. So received salaries by cash, meaning there are two accounts involved. There's a salary and a cash. So whatever it is that you are able to see is the cash. Now I'm saying that a salary banking, what you get is cash. Salary is something that you cannot see. It's intangible in nature, so it falls under the nominal account. We have the rent. Nobody has ever seen the rent before. At rent so nobody has ever seen the rent. So received rent by cash. If you receive rent by cash, meaning there are two accounts involved. There's a rent account and also a cash account. So received rent by cash. Whatever it is that you collect is cash, not rent. You can't collect rent because it's you cannot get the rent because it's intangible. You can't see it. Whatever it is that you collect, it's in form of cash. So rent falls under the intangible, the nominal accounts. So now we are still talking about the golden rule, which is also known as the double entry system, where we have where I earlier explained that it has double effect on both parties involved. So in every transaction, there are two accounts. In every transaction, there are two accounts. There's an account that is giving. There's also an account that is what? Receiving. So this is what we are going to talk about. So we have the classes of accounts, and the classes of account has a lot to do with the double. In fact, the double entry system is now based on the classes of accounts. This is where people get it wrong. Once you skip this chapter, accounts will be very, very difficult for you because there are certain transactions that will confuse you. So you have to understand the classes of accounts in order for you to be able to know where that transaction, on which side of the transaction should be credited and which side of the transaction should be debited, because that is accounts. Accounts is based on the double entry system. So if you fail to understand the double entry system, and if you fail to understand how the double entry system is explained in the classes of accounts, it will be very difficult for you to understand accounts, even when you go in details. You still be finding difficulties because you skipped this level. So let's talk about how the double entry system affects, or how the double entry system should be applied in the classes of accounts. So under classes of accounts, like I said, so we have three classes of accounts. The in-person account is no longer, we are no longer using it now because it has already been dismantled. So now, the classes of accounts, first we have the personal account. I've already explained what this personal account is. So under personal account, under personal account, like I said, this is an account related to human beings and names of organizations, or an account for persons. Now, under this personal account, we debit the receiver. The receiver should be debited, and the giver should be what? Credited. It is only a human being who can give and receive. No wonder we are saying that you debit the receiver and you credit the giver, because it's only a human being who is able to receive and give. So under this personal account, we debit the receiver and credit the giver. Finish. We have the real accounts. The real accounts. So these, like I said, these accounts which keeps a record of things that you are able to see and touch. An example is the machinery. We are able to see and touch. We have motor vehicle, you are able to see it and that. So now, under this, a motor vehicle cannot give and receive. It's not a human being. So it cannot give and receive. Land can't give and receive. Who has ever seen land giving and receiving? Land, nobody has ever seen that. So, motor vehicle, and for example, we can only see it when it comes into the business, and we can only see it when it goes out of the business. So, under this, we debit what comes in and credit what goes out. So this is very, very important. You should pay attention to this. So under real accounts, we debit what comes in and we credit what goes out. Simple, you appreciate. No need to struggle. This is very simple. So we have the last one, that is nominal. Nominal accounts. Nominal, under nominal accounts, nominal accounts, these are accounts that are intangible in nature. This is an account which is intangible in nature. It keeps a record of things that you are unable to see and touch. For example, I said rent, nobody has ever seen rent, salaries, commission received. So this nominal account talks about the income and the expenditure. So this talks about the income and the expenditure. So under this, what do we do? So the golden rule, this is how you should apply this golden rule on the nominal accounts. So under this, you debit the expenses. All the expenses should appear on the debit side of an account. You should credit the losses. You should credit the losses. Sorry, you should debit the expenses and the losses. Sorry. You should debit the expenses and the losses. So the losses and the expenses should always appear on the debit side. You should credit the gains, commission received, rent received. Those should appear on the credit side of the account under nominal accounts. So rent received, so those accounts are supposed to be credited. The expenses and the losses should be debited. For example, let me give this example. Maybe received rent. Received rent by cash, 50 kwacha or 500. Received rent by cash. So there are two accounts involved. There's a cash account. There's also the rent account. Finish. So there are two accounts involved. There's the cash account. There's also the rent account. So like I said, me I use T format because it's very easy for me. But whichever format that you are comfortable with, you can use it. Because like I said, these formats have nothing to do with it won't affect the entries in any way. It's just the same. It speaks the same language. So now, you receive. I want to explain the nominal. Well, someone might ask, say, why do we debit the losses, and why do we credit the gains? Someone might ask that question. So now, this is what I'm trying to explain now. There's a statement under the golden rule of accounts which said, to every credit entry, there is a debit entry. There's a corresponding nankan. So mind you, what you do is, if you have an account that is debited, if you discover that in this question that have been asked, there is an account which is debited, it ends there. Just know that the other account involved should be credited. So this question, when you say paid rent by cash, there's an account which is giving, there's also an account which is receiving. So paid rent of that amount, 500 kwacha, by cash, there's an account which is receiving, and cash account is the one which is receiving. Now, let me take you back to the classes of accounts. Cash account is an asset, and it falls under real accounts. It falls under real accounts. And in real accounts, I said, we can only see assets, like we can only, for example, motor vehicle, we can only see it when it enters the business, and we can only see it when it leaves the business. So under that, those, I said, you should debit what comes in and credit what goes out. So cash is an asset, so it falls under real account. So received 500, received rent worth 500 by